Good evening. I'm David Gerard. I was invited here by Professor Winifred Poster. Thank you to Winifred for the opportunity, and I'm here to answer your questions. So, the first question. Bitcoin was originally proposed as a non-state currency. How can it be used as a currency when it can't maintain a stable value? The benefit of currency is that all parties can be reasonably confident in the value exchanged, yet Bitcoin doesn't yet achieve anywhere near that stability. This is entirely correct. This has been a big problem for Bitcoin. The people who invented Bitcoin had particular political aims in mind. They wanted it to appreciate in value like an investment, specifically like gold, but they also thought it would be useful as a payment mechanism, a currency. So these aims are sort of in contradiction. If something is a good investment, you don't want to spend it. So it doesn't circulate very well. With Bitcoin, as its price went up, theory is that if a currency is deflationary, that is, the value of a given amount of the currency goes up, this will really suppress spending because people won't want to spend money, they'll want to save it for tomorrow. This is what happened with Bitcoin because the merchant case for Bitcoin was really suppressed by the fact that people, Bitcoin holders, wouldn't spend Bitcoins. They'd spend dollars instead. And a lot of Bitcoin merchant use cases fell by the wayside because vendors discovered that people just didn't buy stuff with Bitcoins. So it turned out not to be that good as a currency. There are limited markets where Bitcoin was useful as a currency, ones where people couldn't use better money like dollars. The drug markets are famous for this, the darknet drug markets. These were an insignificant proportion of the world drug market, but they're an interesting case study, particularly if you turn into a bit of a payment nerd. So the trouble with Bitcoin's volatility, price going up and down, is it would often mess up deals. And drug sellers are not famous for their patience and forbearance. So you'd have deals being messed up by Bitcoin's volatility, by transactions being slow and unreliable, particularly after 2015 when Bitcoin filled. They alleviated this a bit by switching to other cryptocurrencies, but these are similarly unstable even if the transactions go through. It's a very fraught area for people trying to deal in these markets or trying to use Bitcoin as a currency. I mean, there are legitimate payment use cases as well, such as people being paid in foreign countries where it's hard to get, say, dollars in and out. But they have to contend with the volatility as well. Remittances being transmitted by cryptocurrencies hits the same problem. If cryptocurrency doesn't pan out as a viable currency, do you expect the blockchain technology to be used for other applications such as contracts? Not really. Now that's basically a book-length answer in itself. The blockchain technology is really a database in a particular format, a form of distributed database. So the question is, who runs the database? The clever bit in Bitcoin was not coming up with the data structure, like it's been around for a few decades. It's a hash tree or a Merkle tree. It's pretty well known in computer science and it's used when it's applicable. It wasn't new with Bitcoin. They never claimed it was. So the actual technology, it's getting some play being rebranded as blockchain, but it's pretty old technology, the bits that are good and interesting and work. The bad bit is the Bitcoin consensus mechanism, where they waste a country's worth of power to process about 7 transactions a second in the world's most inefficient payment network. I'm not sure that's useful for anything except for cryptocurrencies for a particularly small audience. There's been a lot of people trying to turn blockchain technology to something, and they always seem to either end up with something that can't possibly work and is just meant to sell RCO tokens, or they end up with something that's functionally a centrally controlled database with someone picking who gets to use it. And third question, how susceptible do you think cryptocurrencies are to hacking? Are there recommended steps to prevent theft? So the big problem with cryptocurrencies is irreversibility. I mean, I've been following this for a while, and as far as I can tell, the big problem with cryptocurrencies, everything that is wrong and doesn't work about them, comes from the immutability. What this means is that all mistakes, thefts, hacks are final. If I pick your pocket from the other side of the world, those are my bitcoins now. This is huge. Everywhere else in the financial system, up to really quite high levels, you will eventually have final settlement, but thefts are quite reversible in quite a lot of cases. So recommended steps to avoid theft: 1, don't do that. But if you must, a lot of people recommend using hardware wallets, but those aren't a panacea. We've had people hack the software for the wallets. There are various scams involving second-hand wallets. There's the thing about a cryptographic system. Now, Bitcoiners will talk about a common excuse for the power use of Bitcoin is that this provides cryptographic security for the chain. It does that, but the system is still suffused with hacks and thefts. So what this means is it's like taking a 6-inch thick steel blast door and putting it in a plastic frame. And they will tell you we must use more power because that'll make it a 12-inch thick blast door. That's even more secure, and it's still in a plastic frame. Nobody attacks a cryptographic system head on, and they don't attack the strongest part. A chain is as strong as its weakest link, so you attack a crypto system where the weak points are. Perhaps you can get into someone's PC. Perhaps you can steal someone's password. Perhaps you can socially engineer a user who has access to something. Perhaps you can get in through a dodgy web page or a shared database. All of these have happened, and they happen a lot. So if you want to be your own bank, that means you are being your own chief information security officer. And that's quite a big thing to ask. There's a reason why civilization is built on division of labor and why we outsource this to banks to do it for us, because they're better at it. Next questions. Bitcoin believers say that because a limited number of Bitcoins exist, the market price will stay high. But new cryptocurrencies are entering the crypto market all the time. In what ways does increasing variety of cryptocurrencies affect the market value of Bitcoin and other cryptocurrencies? So there's a number of things tangled up there. Bitcoiners do believe that the limited issuance of Bitcoins, there'll only ever be 21 million Bitcoins because Bitcoin governance is so dysfunctional that they'll never change anything about the protocol, basically. Or they'll tweak minor details at best. And they believe that this will keep the price high. So the trouble is that the Bitcoin maximalist position is that all those other cryptocurrencies don't matter. They're just cheap imitations. Bitcoin is the real thing and it's qualitatively different. I don't think that's supportable. I think this is actually, you have correctly identified a major weakness of this theory. Like, I think the theory is wrong, but even within the theory, it doesn't work because anyone can cut and paste Bitcoin. Like, Bitcoin is only like gold if you could create new gold mines by Control-C, Control-V anytime you wanted. So, of course, a lot of people immediately did that. That's why there's thousands of altcoins and why there are others like centralized coins like Ripple, which doesn't use mining. It has centrally picked administrators. ICO tokens, which are completely centrally controlled. These are all called cryptos, and they're all traded on the same markets. The real-life market doesn't consider these different things. Bitcoin is the biggest, but it's not qualitatively different. So in terms of market value, what affects the market value of a crypto is whatever price it was last traded at. Trading is really thin in cryptos. Even Bitcoin, the biggest one, trading is really thin. Noticeably thinner since the bubble popped. Trading is right down. So the market cap of a crypto is pretty much an imaginary number. Like you could crash a $2 billion crypto with about a few $100,000 of trades, and that's where did all this value go? The answer was it didn't exist. So market price really depends on how many people are putting actual dollars into the system. So this turns out to be a limited number. I'm not going to try to explain tethers, but they're a sort of dollar substitute token which appears to be quite difficult to change back from tethers into dollars, and it's all quite complicated, and I strongly suggest you do some reading up on it. It's quite controversial, and there is fairly solid academic work that statistically Tether has definitely been used to pump the price of Bitcoin, and something like 80% of daily trades that are supposedly US dollars are actually tethers. So to a large extent the price is imaginary and manipulated. Good luck cashing out. Next question. People are not only buying Bitcoin, but creating new businesses from the ground up based entirely on Bitcoin. Such as some friends of mine who founded a travel company that uses Bitcoin to bypass centralized travel platforms. Clearly you're skeptical of the real value of cryptocurrencies, but what kind of fallout do you see with such businesses when these magical internet monies finally bottom out? Okay, so there are real businesses built on Bitcoin. A lot of my objection is to the hype version where Bitcoin advocates would say, of course, Bitcoin will destroy all other international businesses. It will take over the field of remittance because it's so wonderful and fast and free and cheap and so on. Whereas in practice, what happened was all of these businesses are marginal, have a few percent of profit somewhere. You can lose that few percent, you can make it up somewhere else maybe, and everything always turns out to be a bit more complicated than that. I'm thinking of one remittance business, Veeam, who use various conduits for international payments, one of which is cryptocurrencies, but sometimes on a given day, banking system might actually be better and cheaper. So I suspect that if they have multiple paths to transmit money or whatever, then they'll probably be okay. I mean, there is a small use case for Bitcoins. I know people who've done quite well accepting Bitcoins, at least until the recent transaction clog trashed it as a payment mechanism. So, it's not impossible. But taking over the world, I'd have to see it first. So basically it will depend, their business's health will depend how adaptable they are to changing circumstances and whether they have a solid business there in the first place. And thirdly, how would you compare a crypto crash against an economic crash like the 2008 recession? Well, I would and I wouldn't. The 2008 financial crash was huge, international, and systemic. The similarity to Bitcoin and cryptos is it was a bubble, specifically a property bubble, a dodgy financial assets bubble, and that sort of thing. Crypto is, both the 2013 and 2017 bubbles were pretty standard asset bubbles. Something went up in price for no good reason and people bought in because it was going up, and it got in the papers because it was going up, and people said, this is definitely not a bubble. That is a sure sign of a bubble. So, yeah. It compares only in they're both bubbles. The thing about crypto is it hasn't really crossed over to the real economy much. Like, the crypto crash doesn't affect the productive economy. It's a bunch of crypto people killing each other. So the rest of the world doesn't worry too much about that. It's when they start affecting mum and dad investors that regulators like the SEC get involved. but it doesn't affect everything the way the 2008 recession did. Next question. Why store Bitcoin in exchanges if the value of Bitcoin is so volatile? Well, the reason to store your Bitcoin somewhere is because you think it's better than storing them on your own computer. A lot of people keeping them on exchanges are doing so because they don't know what else to do with them. They don't feel confident that they can store them themselves. They think the exchange will do a better job. Sometimes it will. So exchanges are sort of not very good banks in this regard. Often they will keep the cryptos on the exchange because they want to trade them. And it's much easier when they're right there. So, yeah. As a volatile trading medium, that's overwhelmingly the current use case for cryptos. Drug buyers have given up on Bitcoin because it turns out that if you're going to do crimes, then doing them on an immutable ledger that is permanent is a bit silly. People are still getting busted for deals they did on the Silk Road many years ago. Question. What is the incentive to sell Bitcoins at any one point unless the assumption there's a set number is unrealistic? Well, the set number doesn't actually matter. People sell them because they want to make money. The price goes up and down like a yo-yo, 5 or 10% a day sometimes. Professional traders see that much volatility and they go, woohoo, money. They love volatility. So that's why professional traders are interested in crypto. There is nearly no crypto economy. You can't spend Bitcoins with people who use them to buy other things in Bitcoins. There's no circular flow of income, really, or negligibly. So basically, people buy and sell cryptos in order to get conventional currencies. So that's the incentive to sell. So if the point of Bitcoin is to eventually exchange for usable money, why do some Bitcoin users root for economic downturns? I could say because they're nuts, and I think that is the actual reason, and they don't know what they're on about. I find myself unable to quite understand people who think that come the collapse of the existing financial system and the descent into the Mad Max gasoline punk future, there will continue to be reliable internets, ASIC mining factories, and electricity while you're trading for lumps of food. I don't know what they're thinking, and you'd have to ask them what they are thinking. So, next question. Because advocates of Bitcoin believe that eventually this system will be the saving grace of the economy, is there a conversation happening on educating society about cryptocurrency? Do they believe it will happen organically? As anyone who's encountered Bitcoiners will know, you cannot get them to stop talking about Bitcoin. They will tell you about it at any opportunity. Everything is a conversational opening for Bitcoin. These guys have calmed down a bit since the last crash. But basically, if you got an axe and cut their head off, two heads would pop up from the stump and they'd both be telling you about Bitcoin. So I think basically they're just really, really bad at it because actually its arguments are pretty bad. And the argument that really convinces people is I can make money that I can use in my daily life on this stuff. That was certainly the argument during the bubble. Question. What does the value of Bitcoin depend on, and who makes the ever-changing values known? Well, the price of Bitcoin is the price. If you see a price on, say, CoinDesk, the CoinDesk index, there's a weighted average of exchange prices. That number is basically fictional. Like, they quote that number to the cent. It'll be like $6,853.29. This is a lie. That level of precision is where they are lying. It's a marketing lie to make Bitcoin look like a reasonable asset that is in a regulated market when it's not. The exchanges that trade Bitcoin, the spreads between exchanges can be on the order of hundreds of dollars. So a price might be 6,800 plus or minus 200. That would be a fair statement. The price, it's not like stocks where there's a requirement that all the orders be moved to the exchange where they can be filled at the right price, and it keeps prices really steady. With Bitcoin, the exchanges tend to have custody of the Bitcoins. The order books are not shared, so the order books are thin on each exchange, which makes it really volatile, makes prices go all over the place. Obviously, if you have high prices in one place and low prices in another, you'll try to arbitrage the prices. Buy on the cheap one, sell on the expensive one. This happens as fast as it can happen, and that's still not enough to alleviate the hundreds of dollars of spreads because the market's really badly structured. So if you see one number for the Bitcoin price and it doesn't say on such and such an exchange, then it's probably one of these made-up averages and you shouldn't pay it too much attention. Where are we? What are the biggest challenges of a non-state system like Bitcoin? What if your wallet gets hacked? How can Bitcoin users protect their assets from hackers? Well, we covered what if your wallet gets hacked, you're out of luck. How do you protect your assets? Make sure you are that good at security. As for the challenges of a non-state system like Bitcoin, your problem is actually in practice that one, no one runs it, but two, the people who do run stuff aren't very good at it. It's very amateurish. It was made up on the spot. Now, you can argue that this is the evolution of a financial system, that this is how the system refreshes itself, that new instruments come along, people get into those instruments, they build up the same structures that existed before, that one becomes old and ossified, and then someone does a new one. You can say that to some extent. What we see in Bitcoin is all the people who talk about how you don't need middlemen anymore, their new middlemen are springing up, where exchanges take the place of banks, that sort of thing. You can't sue the blockchain, but you could possibly sue an exchange, for example. So the system is slowly coming together. The crypto world is discovering, and this is good, that unregulated doesn't mean impossible to regulate or a completely free of government society. It just means the regulators haven't shown up yet. And the SEC and CFTC have been showing up big time in 2018, and this is probably good for the area. I anticipate in the next few years, cryptocurrencies will become more normalized financial instruments. There will be regulations, people will understand their regulations. I expect the gateways to and from conventional currency will be more and more tightly regulated. That is, if you want to trade your Bitcoins for dollars, the exchange will need to know the provenance of all your Bitcoins, that sort of thing. And I think this is good. What else? There are many third-party apps or platforms that interact with the cryptocurrency ecosystem, such as digital wallets and digital trading companies. How do these systems provide some type of deposit insurance or a mechanism to make Bitcoin users trust their assets will be safe when going through their platforms? They don't. If your Bitcoins are hacked, you might well be just out of luck. That's not good. So some exchanges, like Coinbase and Gemini, I think, say that their dollar assets are in FDIC insured accounts. That's good. Those are backed, but that's only the US dollar deposits, not the Bitcoins. If the Bitcoins are hacked, then you may just be out of luck. Or the exchange may say, so sorry, we've been hacked, all your coins are lost. You can sue us, maybe. When Bitfinex got hacked in August 2016, they applied a haircut to all their users. 36% was taken away. I know that some users tried to sue them for this, but they couldn't track them down through all the various channels of corporate shells. And eventually they did make good to the users just in time for the US dollar banking to be cut off, which I think started the current bubble. So see the book for how I explained how I think that worked. So the answer is you're out of luck and it's a mess. So yeah, what are the bit license regulations? This is a New York regulatory requirement. If you want to operate a crypto exchange in New York State, you have to sign up for the bit license. It has various rules like know your customer laws, maintaining assets in a certain way, FDIC insurance for your dollar deposits, that sort of thing. Some exchanges say we do not deal with New York customers. Some ICOs say we do not sell to customers in New York. Even if you're an accredited investor in the rest of the US, we will not sell to you in New York. Many protest volubly. Shapeshift actually left New York entirely because of the bit license. They objected strenuously. Coinbase and Gemini exchanges notably were huge fans of regulation and thought it's good because they're the biggest guys. Big guys tend to like regulation because it helps keep smaller fly-by-night cowboys out and makes their big businesses bigger. So yeah, if money cannot work without the technological and regulatory infrastructure enabling it, who states the regulations for Bitcoin and other cryptocurrencies? Well, it doesn't work very well as money. I mean, you can call it money. The English word money has a lot of shades of meaning and it fulfills some of them. It doesn't do them very well. The code determines more or less what it does. The code and the community who accepts the code and accept certain developers committing to the code and use whatever results more or less from consensus. So no one's actually running it. This is not ideal in a number of ways, but as we've just detailed. What other types of cryptocurrencies exist apart from Bitcoin? What's the difference? Why is Bitcoin the most widely known? Well, there's basically Bitcoin-style proof-of-work coins where you have mining and waste a lot of electricity. There's proof-of-stake coins where which operate similarly and try to have similar guarantees, but they use a different consensus mechanism, which look up proof-of-stake on Wikipedia. That'll give you a good rundown. I won't go into it here. This is not very proven. Ethereum is trying to move to a proof-of-stake system, but they are a large system with billions of dollars of notional value in them, so they know how to get it right. There are also things like Ripple, which is a completely centralized currency. Ripple Labs determine if you can run a node, and there's no mining. So yeah, there is ICO tokens, which are completely centralized things created by someone who runs a contract and then tells you it's decentralized because that way they can sell you more tokens. These are all called cryptos and all traded together. Bitcoin was the first one. It's the sort of well-known brand name. Crypto, Bitcoin is a synecdoche for cryptocurrencies. So it's still the most important, but yes, it's one of many. In the year 2050, how do you see what the world will be like after cryptocurrencies have been around for over 40 years? As I said, I think that in the next few years, cryptocurrencies will become more normal, regulated financial instruments. And we will see if they have a use case. I still haven't really seen one yet. They're things you can trade and maybe make money from in a zero-sum trading environment. And you can make lots of money from them, and you can lose lots of money. I do not touch them because I know that they are well above my risk comfort threshold. It's possible that some revolutionary new cryptocurrency will come along that has all the good characteristics of Bitcoin and none of the bad ones. I will not say that's impossible, but I will say that I will believe it when I see it. The burden of proof is 100% on the advocates. For 9 years now, cryptocurrency and blockchain advocates have been saying, we've got great stuff coming in the future, you cannot prove we don't. However, I think 9 years of failure is not evidence that is not usually considered evidence that success will follow thereafter. So I will say that the burden of proof is firmly on the advocates. There's a few people working on this stuff who do understand the burden of proof is on them, and that's fine. I look forward to their interesting work. But yeah. Question: how can the blockchain technology help empower Puerto Ricans to rebuild the island after the economic depression, the aftermath of Hurricane Maria? What would it mean for Puerto Rico to become a crypto utopia? What would be the benefits, and how do you achieve that? I think that's something that is not going to happen. The technology is a database. It's not a database that makes bureaucracies magically more efficient. You have to do the work. The cryptocurrencies, a lot are traded in banks based in Puerto Rico, and that's about it. And a lot of crypto advocates love it there because they think they can have an anarcho-capitalist feudal economy where they are the guys with more crypto than anyone else. That's the main drive of this sort of thing. Actually fixing it will require politics and work on the ground and all sorts of hard stuff. And I really don't see cryptocurrencies being a part of that or how that would even work. Next question. Shouldn't the law of diminishing returns push even the most resource-rich miners out of the business quickly? Yes. So Bitcoin mining works as a sort of Red Queen's race. The more computing power goes to Bitcoin, the more difficult the network makes it so that you always have 10 minutes per block and per Bitcoin reward. So even as mining becomes more efficient, miners throw more electricity at the problem, and the price will naturally equalize to about 1 Bitcoin to mine 1 Bitcoin. That equalizes over the course of months, so if there's a bubble, you can make a lot of money as a miner if you have the capital expenditure to have a lot of mining. This is why mining centralizes and why one company, Bitmain, run 2 of the mining pools and have about 50% of the mining, and they make 80% of the mining chips. So decentralization went out the window around 2014. So basically they are competing to get the actual dollars that are flowing into the cryptocurrency ecosystem because they can't pay their electricity or hardware bills using cryptos. They have to use actual money. 2. How can Nakamoto expect to reach the 21 million limit? So this assumes that Bitcoin must die if miners can't make money from it. The thing is, Bitcoin is really hard to kill. All you need for a cryptocurrency to keep living is a copy of the software, a copy of the blockchain, and 2 or more advocates who are interested in it. Out of 7 billion people, you're going to find 2 geeks who want to play with this computer program. So we will see something called Bitcoin that has the Bitcoin software or as an ancestor and the Bitcoin blockchain as an ancestor in decades to come. How useful and popular it is an open question. 3. If they do not, and instead expect that there always be room to grow, with 21 million being an eventual theoretical maximum, doesn't this create inflationary conditions that undermine one of the core arguments for Bitcoin, i.e. that it cannot devalue through inflation because there's a set amount that can exist? So the question of devaluing through inflation, that assumes that inflation, that the purchasing power of money is the same thing as increases in the total supply of money, M0 narrow money, cash as we call it. This is a confused idea and is one of the reasons Austrian economics is wrong, because it turns out those 2 meanings of the word inflation are not actually closely linked. And that's why the central bank can release more money, more M0, print more money, quantitative easing or whatever, and it doesn't cause inflation and when they wanted it to. And sometimes inflation will happen because the economy is getting overheated and they have to reduce the money supply or slow down the rate of issuance. And this is why economics is really hard. So I think the answer to your question is that Bitcoin's assumptions are bad, and economics doesn't work like Bitcoiners think it does. And the final question. I wonder if it is naive for me to be attracted by the concept of cryptocurrencies, or if, indeed, it is truly a valid concept to take seriously, one in its early infancy experiencing growing pains, not comprehended by the unsophisticated and those with lack of vision. So that's not an unfair question, because the pitch is really attractive. And also, technologies do take time to mature, and we have new technologies all the time that come along doing new and amazing things. But you also have to compare that Bitcoin and blockchains mostly have a track record of failing to be very useful for things, and most of their claims didn't really work out. And after 9 years, it's fair enough to say, where's the beef? And as I said, a history of failure does not mean that you should then expect success. Usually, if something has a history of failure, you expect it'll have a history of failure. So it could break through, but that won't be related. The pitch is very attractive. I find that what it really fails on tends to be the details. Like Bitcoin doesn't scale. Bitcoin cannot scale up to what it wants people to do. Bitcoin economics doesn't actually work the way it was supposed to when they planned it, because economics doesn't work like that. Stuff like that. So, and as I said, we could have someone come up with an advance in computer science that means you can have a scalable Bitcoin that doesn't use a country's worth of electricity. But I'll be delighted to see it when I see it and not before. I think there might be some no free lunch theorems in there, but I'm not enough of a mathematician to solidly back that idea. It feels like it. So I could be wrong. It could all succeed hugely, but I don't think a track record of failure so far indicates future success. It could be a technology in its infancy, but it's really had the crap beaten out of it for the last 9 years, and this is what we've got. A common comparison point is to say, but it's like the early internet. It's not like the early internet. Like, could you have predicted Facebook in 1983? Well, yeah, actually, you probably could have. I was on the internet in 1988. Actually, it was Usenet. We didn't even have the ARPANET in Australia at that time. So I got on the proper internet in 94, and I've been there since. So at every step of the internet and the ARPANET since the 70s, it had a track record of success. It was a real system used by real people for real work. They added new functions, they used those. There's a lot of stuff they added that didn't go anywhere. If you look through Internet RFCs, you'll see a lot of technologies that fell by the wayside. And that's fine too. But sometimes things don't work out. Most new ideas don't work out, and that's why they're new. Some do, and they're very impressive. And I think that comparing a technology that has failed for 9 years to literally the greatest revolution in human communication since the printing press may not be a reasonable comparison to make. So it's possible that it will succeed because of this, but the comparison to the internet is always brought up as an excuse for failure. I don't want to be too hard on it because it was interesting, but I'm not sure it's feasible. They are different things. I find it completely fascinating, even as I think a lot of it's trash. But it could be a failure of imagination, or it could just be looking at something that is failed, repeats the history of finance, has attracted scammers like every new financial instrument ever, and going, we've seen this story before. So it's a bit different. We'll see what happens. Thank you for this. I'm sorry I couldn't do this live, but I don't have internet at home at the moment. So thank you to Professor Poster for setting this up.